The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How are you doing, Guy?
Pretty good. Yourself?
Good. How long have we known each other now, Guy?
1990, give or take.
You know, remember when I used to say 90, I was thinking that's not too long ago.
Right.
I guess it is a long time ago.
It is a long time. 26 years, right?
We both had a lot more hair back then, I remember. I used to could swing my head and the hair would fly down. What happened to that?
We weren't near as smart then, though.
Oh, that's right. Much more experienced and wise now.
Yeah, didn't know what we were doing, did we?
That's right.
No.
Now that I know, I can't do anything. Right? All right. Remember we developed this show to answer your financial questions. You know, anytime we get questions from interviews with clients, potential clients, phone calls, emails, if we find them that we think are going to appeal to a general audience or a bigger audience, we're going to share them with you. We always take away the names. We don't want anybody embarrassed or whatever.
And I will say this week, we got several good questions that were called in. I think a few of our listeners actually tried to call on Saturday. Of course, we weren't there, but called back earlier in the week and had some good conversations. So if you've got questions and you just want to call and ask us the questions, it's 972-715-2424.
That's right, 972-715-2424. You can always go to ilovemyretirement.com. You got to click a few places there. I'm trying to get a landing page right on the front page for now. So it's easier if you want to call us, like I said, at 972-715-2424. If you're out of the Metroplex, you can call 1-800-McClure. Remember, McClure has 2 C's. All right. Before I get started on this week's questions, we've talked a little bit about it before, but I just had another case.
And no matter how many times it happens, it still just aggravates you, doesn't it?
Oh, my gosh. Well, a client comes in for a retirement plan. This happens a lot. What happens is they plan on retiring at a certain date in the future, and they were forced into retirement. If anybody tells you the companies don't age discriminate, they're not telling you the truth. I understand it's against the law, but what you'll find is they're like, wait a minute, we're paying this old guy this much. We got this young guy that the experienced person's been training for a year. You don't realize when you get a certain age, you're training your replacement.
And it's all about the money for a lot of corporations, unless it's some nice private family deal that you have. Your insurance gets more expensive as you get older. The family's getting older, so the insurance compounds. You're getting paid a lot more than a new guy is, like Victor said, the guy that you're training. So it adds a lot of negatives for a lot of companies.
And so we're going over the portfolio, and this happens way more than I'd like. We look at everything. The person has saved a decent amount of money, but come to find out that 95% of it, at the time they did it, it was 99% of their assets are 100% in illiquid private investments. Now, no financial advisor worth a grain of salt would ever put you 99% of what you have investable in something illiquid. They knew that this person was going to retire in a year or two anyway.
And non-licensed.
And they did not care. And that's what we say. Anybody that ever promotes private investments, don't walk out of their office, run. Because there are no laws. It's like the Old West. All right? There are no laws. Like, I'll give you an example. We're registered investment advisors, Guy and myself. We're legal fiduciaries. We have to put your interest first. We're not going to put all your money in something illiquid. Now, there's a difference between liquidity and a penalty. If you put all your money in a 5-year CD, it's still liquid. You just have to pay a penalty if you break between the 5 years.
May lose the interest.
That's right. Or an annuity, same thing. That's still liquid. What I mean by illiquid, my lake house took almost 3 years to sell. I got about 20% below the lowest of 3 appraisals. That apparently wasn't liquid. Neither is a private REIT. REIT is a real estate investment trust. What happened was all the life settlement guys were selling that crap. You know, they came to my office with their dog and pony show. They came in from
Tried to get us to sell.
Oh yeah, from Waco, and said everybody's doing this stuff. We're going to pay a 10% commission. I'm like, well, that sounds like a lot of commission, but where's that coming from?
Exactly.
Well, it's plenty. They're going to make 15% a year. Everybody lives 4 years. You know what you're getting before you get it. Blah blah blah. Then they found out that they got some doctor in Denver that's just signing off that every 70-year-old's got a 4-year lifespan. And the last thing I checked, 90% of people are still alive 15 years later. And the whole thing about they're all in bankruptcy court now. They can't get their money out. They'll be lucky to get anything out.
Yeah, and think about it. Let's say you have $1 million, nice round number, and how heartbreaking it would be if you put $100,000 or $200,000, 10 or 20% of your net worth in this, and it's gone. Can you imagine if you sat down with these guys and they're very good salesmen, it's sexy, it's emotional, the potential returns, all of that, they're very good at what they do. And they talk you into putting almost 900,000 of your million or all of your $1 million into this and a REIT and some other things, and that's all gone. Your life has completely changed.
And what they do is they'll go on what's hot for the moment. Like right now, they're all doing the private real estate investment trust. Like we buy apartment buildings, only the grade A properties. You're getting a piece of those. And here's what will happen once you buy these private REITs. All right. First, all the money that they make, they're going to put back into buying more properties. So you're not going to get anything out. If you do, it's a small amount, and that's just to get you to buy more. It's called seeding. Let's seed these guys, let them pay out a little bit. Then they put their big money in the second time. And that's what happens to this particular person, just like all of them. They never put it all in at first.
That's right.
They put a little bit in, they seed them with a little profit, boom, they've come into the whole rest.
And they bring referrals, too. They refer their friends. And if you're referred to something, you have a tendency to come in stronger.
That's right. And then after that stops, which it always stops, now we're going to grow the company. We're going to take all the proceeds from rents and all that stuff. We're going to buy more properties to make this really big for you. Problem is, it never goes anywhere. And what happens is, it's now 100% illiquid. It produces no income, and you can never get out of them. They'll tell you when they sold it to you, oh, absolutely, we can find another buyer. Obviously, with these kind of returns, buyers are plenty.
With the quality of these properties and this REIT, we fully expect next spring to have several suitors wanting to buy this.
We're going to go public. We're going to go public, and then 10 times your money is going to come out.
That's right.
They're all full of it. I've been doing this for 30 years. What percentage of private investments, private REITs, private movie deals, private cable deals, all that stuff, what percentage go bad, do you think?
Well, I thought I was prepared for you to say what percentage work, and I got a better response for that. I was going to say, close your eyes. What do you see? Nothing. They don't work. The problem with the REITs, some of them allure you with a 6 or 7 or 8% return, and they'll actually pay that for a few years. And then your friends see you getting it, they want to get it, more money goes into it, but you still have to go public. You still have to create a market to get your return of investment back, and it very seldomly happens.
And there's no laws like there are in public investments. Public investments, you take a company public, you got like 15% profit. That's the most a brokerage firm can make. Well, if you're private, let's say I bought an apartment building for $1 million. I'm selling it to the investors for $2 million.
That's right.
And I'm selling them a 49% share. So basically, I've doubled my money, and I own half of it.
That's right.
And then we're going to charge
quadruple the price.
That's right. We're going to charge a management fee. Well, obviously, over the years, inflation has hit. We're going to have to double our management fee. They will drain it out to nothing. That's why you'll never see them work. Don't get trapped into private investments, especially not huge amounts of your money, because these guys aren't licensed. They have no fiduciary responsibility. They tell you like it is. And what you've done is when you sign those forms, you didn't realize. You said, I am what do you call it?
Accredited investor. And where Victor's going, if I can take the baton, they give you all that information in a prospectus and pretty much know that you're not going to read it. Or if you do read it, say, well, they have to put that in there to cover their butt. But they'll tell you conflicts of interest, meaning they run it as well as sell it. They'll tell you about commissions. All of that will be disclosed.
But they don't tell you how high it can go because there are no limits.
Correct.
There are no limits to how much profit they can make. It basically just drains it all out of you. So that's why I've always said, If anybody sells private investments, get out of their office now. Don't talk to them on the phone. Think about it. There's 2 people in Dallas right now that were on the radio, similar radio shows to this, that sold those private reads. Every one of them lost their license. If there's any still doing it out there, if they haven't lost their license, it's because the feds ain't caught up with them yet. You got to be careful with this stuff. You know, if you see ridiculous returns, some kind of, this is private. If somebody tells you, well, I don't normally let people in this, but I'm going to let you in because you're special. You got to run from that stuff. It could be a friend of yours. It could be an uncle. I'm going to let you in a real estate deal. I'm a billionaire. They drive a Ferrari. Well, they're like, oh, the guy drives a Ferrari.
He must know what he's doing.
That's right.
If you're a senior and you've got money amassed, you've saved money, you're a target. Be careful, please.
That's right. And we're going to do this after we return from the break. We're going to go over your financial questions. We got a great show planned for you today. Stay with us. Don't hesitate. If you have any questions, to call us at 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. And, that brings up a point. If you really think about your investments before you do things, really think about it. Try to ignore the sales pitch and all that. Just look at the numbers. You'll prevent yourself from making a lot of mistakes. Scams on seniors are one of the worst things that can happen. It happens all the time. But if you really think about it, let somebody else, and you know that most scams on seniors aren't reported because they're embarrassed that they fall victim to this scam.
And the other thing is, if you're going to get creative, getting creative with your life savings when you're close, 5, 10, even 15 years from retirement, that's not the time to get creative. They've got derivatives now. They've got all sorts of unit investment. There's all sorts of good investments out there as well. But, you're getting in a consolidation time right now. You want to be careful. You want to have diversity, sure, but you don't have to be creative. I know it's emotional and the potential sound really good, but don't be creative when you're getting close to retirement.
Even when you're talking about legitimate investments, you got to be careful. How many people now do you know out there that are now getting into real estate? They're going to put all their money in rental properties.
Oh, it's the hottest thing
That's
going.
the hottest thing going. You're stupid not to do it, right?
Oh, it's crazy.
I'm going to put every dime I've got into rental properties. I get it. Right now, per dollar, income-wise, rental properties are fantastic. But what happens every single time throughout history? They'll overbuild because there's such a demand, and then there'll be a glut. And then rents and vacancies go up. It's not the answer. You can't put all your money in one particular source and expect it to do something. Now, that's different than a CD or an annuity or something like those are guaranteed income streams regardless of what happens to the economy.
Now, I know I'm going to upset the real estate people out there, and I don't mean to because there's a place for it like everything else.
Half my friends in real estate.
Oh, no, I know. And they're doing quite well from what I understand.
Absolutely.
But I had someone ask me the other day a question and said, I want to buy a bunch of real estate. And I said, well, now would be a real good time to sell real estate if you had a bunch to sell. Because the market's at a peak. I don't know if it's the best time to buy it. Well, Guy, you don't understand.
I know. Now, I think for the next 3 or 4 years, it's still going to be, maybe 5. It's still going to be good.
But you're buying when it's high.
But it's something you can't count on for your retirement to have 100%. That the rents are never going to go down, that you're not going to have vacancies, repairs. There's all kinds of things that can happen. If you've been in Dallas as long as I have, which is all my life except for the 6 years I was in the military, it happens all the time. It's got a good market, a bad market, good market, bad market. Long term, it always seems to go up. But you got a lot of in-betweens there. And if you're in retirement years, a lot of in-betweens can hurt you. Plus, I'm not fixing a toilet at 2 o'clock in the morning for nobody.
And I'm not a real estate expert, nor would I profess to be, but I've seen successful people, some of your friends, Victor, that do it. And the ones that I see that are successful, that are buying these rental homes, are usually buying the less expensive ones.
Oh, yeah.
And they're getting still decent rent for it.
Are you saying my friends are slumlords? Is that what you're trying to say?
Well, that's not where I was going particularly. but I've seen people that try to do this in the $250,000 range.
Higher.
Oh, no, but you don't understand, Guy. The renters are going to pay this asset off for me.
Yeah.
Well, okay.
I know.
And it can work. But anyway,
Yeah.
be careful.
If you
Don't
ever
get
wanna-
creative when you're getting close to retirement was my point, and I digressed.
All right, now it's time to go over your questions. Remember, these are questions that come in from emails, phone calls. If you have any financial questions, maybe you can email me at victor@victormcclure.com, call me at 1-800-McClure, go to ilovemyretirement.com. Anytime, if you just want to call and chat about anything at all, we'll be more than happy to talk to you. Again, 972-715-2424. Okay, Maestro, what's your first question?
All right. First question we have is, when you're planning for retirement, what are the main things to consider?
The one thing to think about when your retirement is, it doesn't matter. I know this is going to sound weird. It doesn't matter how much you saved. It doesn't matter what age you retire. What is the most important thing? How much you spend. Because I'm telling you, if you spend $300 a month, $1,000 Social Security's plenty.
Now, I don't know. My grandfather told me all growing up, he goes, it's not how much you earn, it's how much you save.
That's right. That's it before retirement.
That's true. That's true. So not what you earn is what
That's
you
right.
save. I understand that now.
That's right. Yeah. When you're in retirement, it just depends. So the biggest thing you have to do is get a handle on your expenses. It's surprising to me that people really don't have a handle on their expenses. They know they're kind of have a general idea, but when I actually get to put a pencil to it, and that's why I always suggest, we put all our expenses on like American Airlines cards so we can get upgrades, first class, and all that kind of stuff, right? But it's handy because it has an accounting of everything. And actually, with certain cards like mine, they'll give you, all right, here's what you spend on lodging, food, and everything.
Yeah, very easy.
Very good accounting.
But there's a new way to do that, a better way where you get better cash back. But we'll talk about that in another show. But I would say this, the two things on the expenses, Victor, you and I always talk about, what are the hardest two things to account for that we don't know the answers to? How long we're going to live,
Yep,
and medical expenses.
Right. But you can't do an effective retirement unless you know what you're spending. And you got to remember, you can't just take your hard expenses. I hear this all the time. Well, I've only got my mortgage is paid off. I got a car payment and this. So all I need is $1,000 a month. And then you go looking and you're spending $8,000 a month.
And you had someone come in that didn't have any entertainment.
That's right. No entertainment, no food, no going out to eat.
Yeah.
Nothing. No travel. You got to have that kind of stuff in there. You get a handle on your expenses, number one. And then you've got to go through, all right, here's my assets. Here's life expectancy. Here's where they're allocated. There's a lot of different things after that. But the number one thing, get a handle, find out what those expenses are. Then you got to use some general rules on how much income you can get from your assets. But first step is to get a handle on expenses. If you're 30 years old or you're 70 years old, I would suggest everyone get a handle on those expenses. Then you can actually do some real work. Well, we got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
That's right. We're the kings of something. Not really sure what. Common sense? Okay.
I've always been told it's good to be king.
All right. Today we're going over your financial questions. Like I said, we do this because we want to answer the financial world. Economics can be pretty daunting and difficult. So we're trying to answer it in real plain spoken language.
Yeah, not using acronyms and
so we try to do it as well as possible. And the feedback we get, our show's been ranked number one in our financial shows in Dallas for a long time, but is they really like the question and answers. So we're going to try to do that as much as possible. All right, what's my next question?
All right, next question would be, what is the best way to choose an advisor? Also, what should I take into account if I decide to manage my own assets?
Advisor is going to be personal preference. The only choice you should have is Dillon Gage and us, right?
I think that's the top of the list anyway. The pinnacle.
If you had to go somewhere else, all right.
If you wanted second or third best, what you should look for is
just make sure they're fully licensed in every area. Make sure they're not only in one area. Remember, if a person just does annuities, they're going to tell you the solution to every problem you have is an annuity. And the same thing with just a stock guy, just does managed account or just does, mutual funds.
Why I hate annuities. Well, I don't sell them.
That's right. It's got to be somebody that's licensed and qualified in all the areas. And hopefully you can get a legal fiduciary like a registered investment advisor. That's ideal. Even though honestly, I know people have made commission a bad word. It's not. It's just a way to be compensated. If a fee is higher than the commission, I'd rather pay the commission, it just doesn't matter.
Well, we'll get into that on the second part of the question when we talk about how to manage. But I would commend that question for the listener that wrote that in, because I think it's very important that you select an advisor more than select a product. Right. How many times, and I think in the first segment we talked about somebody going into unregistered investments, some REITs that weren't so well, life settlements that didn't do well. And what those people end up doing is selecting a product. They didn't go out and interview and select an advisor and come up with this guy.
Right.
They got turned on. They got excited because of the high potential return of the REIT, or the life settlement was going to double and triple their money. And they selected a product that pigeonholed them with this. We'll call them an advisor, but very loosely an advisor. So yes, interview an advisor, same philosophy as you, someone that spends time, someone that asks about you, finds out what you need to do, and then, like we try to do, be solution-based and back into the results for you.
Right. Before I make a recommendation, I've typically spent hours doing the background information to give you an appropriate recommendation, to give you the most unbiased recommendation I can make. Other advisors, you can call them on the phone, tell them, I've got $1 million. What can you do for me? And they're going to try to sell you an investment.
$4 million.
That's right.
Exactly.
You said $1 million? That's exactly what the minimum is here.
Now, most people can't get into this, but I'll make an exception for you.
That's right. This is a very exclusive offer, not offered to everyone, except for the person that just called me that I've talked to for 2 minutes.
All right, we're having too much fun. The second part of that question was also, what should I take into account if I decide to manage my own assets?
Big time fees, number one. Make sure you're in low. I have people all the time that manage their own assets in retail mutual funds. I think that's a mistake. You need to go into ETFs, index funds, individual securities. Make sure the trading cost isn't too high. Make sure sometimes there's a fee just to have the account, which can be onerous. So fees are a big thing. Also, more importantly, make sure you really have the temperament for it. Make sure that, let's say you've always managed your assets and you've done real well. You scoff at Warren Buffett. He's an amateur.
Right.
You do better than everybody.
I know someone like that.
What if something happens to you? Is your spouse qualified and interested enough to even want to manage the money? I'll give an example. My wife is very smart. She's got a couple of degrees, all this stuff, but she doesn't know much about finances. Even if she could learn it, which she definitely could, she has no interest in it. It's the reason I'm always watching, science channels, and she can't stand the crap. She wants to watch the Housewives or something like that. It's a different, people have different mentalities.
I've got to plug our philosophy, and Victor and I always talk about it. Dill Engage, taking care of your hard expenses. If you do that, it just makes what Victor said very easy. Your wife's taken care of. Why? Because the expenses are taken care of. Managing your own account is easier because you're not stressing on it on a day-to-day basis. Why? Because your expenses are taken care of. More and more and more people, and you'll read it more and more now, are saying the same thing that we've been saying since probably 95.
Almost every company. The companies we talked about using annuity to provide income, companies that you would never said they never would, your Fidelities, your Wells Fargos, your Bank of Americas, your Merrill Lynch's, your Raymond James, all of them do it. Now they all do it. Something we were the first one, to my knowledge, to talk about on the radio. In the United States, all of them are doing it now. The ones that said it was terrible, all do it. And so, because I think it's important that your spouse is taken care of no matter what. We got a break coming up. Remember, if you have any financial questions, like to take advantage of our no obligation, no cost retirement analyzer, stress test, and Social Security optimizer, don't hesitate to call our hotline. It's 972-715-2424, or go to ILoveMyRetirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Just a brief thing. We're talking about your questions today. I just wanted to reiterate what our philosophy here is at Dill Engage. We believe that if you've got $5,000 a month in bills, If you have a shortfall between your Social Security and pensions, guarantee the $5,000. Make sure your bills are paid at the minimum, your hard expenses, because you don't have to worry about the stock. Go on vacation, worrying about the stock market going up and down, and worried about the bills. Have the bills paid, and you won't worry much about the stock market. Your life will be better. Your retirement will be better. That's why we call our website ilovemyretirement.com.
I'm going to go out on a limb here now, whether it's the husband or the wife that takes care of the expenses. I know it's either way, but when that person passes, the other one that doesn't will be less tempted to get sucked into one of these life settlement deals and risk losing the money. Why? Because you've planned, because the income is there, and life is good.
That's right. And then we like stocks. Stocks are fantastic for inflation protection in the future. They're fantastic for your liquidity portion of your equity assets. They're fantastic. But after the bills are paid.
They will go up. They will go down.
That's right. Remember, if you'd like a complimentary, no obligation retirement stress test, retirement analysis, and written retirement plan, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. All right, back to your questions.
All right. I don't know if we have enough information here, but I'm going to throw it out. This is a tough one.
All right.
My expenses have gotten to about $10,000 a month. Do you have any tips on lowering my monthly expenses with as little pain as possible?
Divorce? No, kidding. Only kidding. Okay.
I think your expenses go up.
They do initially.
a lot. And you have half to deal with it. That's right.
It really, honestly, with expenses, they are what they are. You know, I remember when I was a kid, I said, if I make $100,000 a year, I'll be rich. If I save $1 million, I'll retire at 30 and never look back. Well, things changed, right?
Oh, man.
Interest rates went to nothing, and cost of living went, remember my dad was buying brand new Cadillacs, Lincolns for $7,000. Apparently,
which was a lot then, right?
Honda Accord's $50,000 now. Just things are different. I get it.
Right.
But the best way I know to save as far as thing is not to change your lifestyle, but just to write down everything. Write down every penny you spend. It seems a little hard at first, but after you do it for a while, you will automatically, psychologically stop or spend less. You're not going to quit spending. Like I said, I want my lifestyle to be the same. My retirement plan is based on me having the same or better lifestyle in retirement. It's not based on me moving into a one-bedroom crappy apartment in a bad part of town, selling my house and all that. That has nothing to do with my retirement plan. My retirement plan is the same, but I have more time to travel or do whatever.
Yeah, and I'm assuming that $10,000 a month is inclusive of a house that's not paid for, because otherwise your house is paid for and you're spending a whole lot on fun, right?
Right.
So if that's the case, and let's say you've got to get down to $5,000, we've run an analyzer for you, or you've done it on your own, and you just can't make it unless your expenses are 5, not 10. Then you have to rebuild and remodel
hard choices.
Everything. Yeah, you probably have to get a nice house, but smaller, different neighborhood, and just rebuild.
Like I said, there's nothing wrong. It doesn't matter how much you save. It matters how much you spend. But you will spend less if you just write everything down. If you'll write, even down to I went and bought a pack of gum. You start writing that stuff down, and you will. And that's the least amount of pain to save money that I know. Also, I'm with Dave Ramsey and a lot of the other consumer advocates. Ramsey's not a financial advisor, but they're a consumer advocate, a good one. Pay off your debts. If you can pay off those debts, that'll make a big difference.
Start with
Anybody
the small
tells
ones.
you, no, invest the money with me, don't pay off the debt, they're looking out for them, not you. Pay off debts. They always ask me, I've got only $100,000. I got about $2 million. Should I pay off the mortgage? Yes. Pay it off. The break you're getting in interest is minimal at this point. Just pay that thing off. The psychological effect, the benefit, is much better than the mathematical benefit anyway. Just pay it off. Go debt-free if you can. I know how hard it is, to not go in debt. That's the society we live in. It's everything. But if you can, absolutely do it. All right, what's your next?
All right, you got to, Victor, you've got to ask me the next question.
Uh-oh, what is it here?
Number 4.
All right. Oh, okay. Do you think the market will continue to go up, or is it ready for a crash?
Yes. To both. Does that work?
Yeah. The one thing is, I've been advocating the market's overvalued now for about 2 years, but it hasn't gone down. Even though it's made new highs recently, it really hasn't gone up either. It went up from 07 all the way through 14, but now it's kind of just set here in between. And so everybody's thinking, well, the PE's high, That's a price earnings ratio. The earnings aren't as good as they once were, but they have gone better. The unemployment rate's a little lower, right? I get all that.
And that's scaring folks right now.
That's right. And overseas, it's worse than it is here, so therefore,
Negative rates.
That's right. I get it. But I went to a meeting with Scott Minerd. He's the head chief information officer at Guggenheim. And he's one of the smartest. I listen to him every year. I go see him every year. He's one of the smartest economists I've ever spoken to. And he said, well, normally it should crash, but the Fed's inability to raise interest rates, they're going to keep them here, and they could drift a little lower, believe it or not. And that has happened. I saw him 3 months ago. It has drifted lower.
Starting now.
He said it could stay up for another year to 18 months. So I do think every market will correct. It's healthy to have a correction because nothing goes up forever. I don't care what it is. If you ever look at a chart that just goes one direction, you're not looking at a chart. It goes kind of all over the place, right? It will have a correction. I don't know when, but he did delay the time that I thought. So maybe if you're, you might have a little more time. I'm of the fact is I don't think it's going to make much more in the next 18 months, but you do have the risk that he's a little wrong. And so if you're taking a little profit right now, it's not a bad time to take a little profit because I do think it's peaking or close to the top anyway.
We'll have to finish this one, I think.
Yeah. We got a break coming up, folks. Remember, if you'd like to take advantage of our no obligation retirement plan, if you just have a financial question and like to talk to us, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, today we're answering your financial questions. If you'd like to take advantage of our no obligation, no cost retirement plan, written retirement plan that takes into account inflation, your expenses, your pensions, your Social Security, and we optimize those, of course. Don't hesitate to call hotline at 972-715-2424. If you have a financial question, if somebody doesn't answer, just leave a message. We'll call you right back. 972-715-2424. All right, Guy, what's my next question?
Yeah, and before you get into the question, I'd add to that, if you have a question on your 401k, you're not quite sure what to do, what a step up in basis would mean, someone passed away, any of that stuff. If you don't want to go through the paperwork for a financial analysis, we understand. Call us. We're happy to explain that to you.
If you win the lottery, this is the first place you should call.
Yeah, 972-715-2424.
Especially those big lotteries.
Okay. All right, here we go. Someone told me that 70 is the new 65 when it comes to retirement. I really don't want to retire at 70. What are they referring to?
What they're referring to, the actual, 20 years ago, the average age of retirement was 60.
And what was the lifespan then,
That's
too?
Right. Now it's 70.
Yep.
Right? It's not because people didn't want to retire at 60. It's because they can't retire until 70 a lot of times.
Yeah.
But there's also mathematical reasons. I'll give you one example. When they invented Social Security, right? They started at 65 because the life expectancy was 65.
Go figure.
They didn't figure they'd have to pay very long.
Oh, and they gave you 8% raises each year you deferred after 65 to 70, right?
That's right.
They'll never use that.
We don't have to pay anything. Now they're shocked that they have to pay so much, right? Well, we're living longer. Mathematically, they're right. Retiring at 70 makes a lot of sense. But I get it. If you can't retire at 70, health reasons, you're forced into retirement, all those kind of things. But if you're healthy, you have the option, you want to keep engaged, I'm telling you, it's a good deal. Because let's say I'll give an example. Let's say you've got an 85-year life expectancy. So 65 means you got 20 years. You're going to have to live on your money for 20 years. Well, just going to 70, you only got to live on for 15 years. Plus, you've had 5 more years of savings. Let's say you're putting in your max 401k, which is $24,000 a year, and you got a match. So you're getting another 6. So $30,000 a year times 5 years, you got another $150 to live on, and you only have to make it last 15 years instead of 20.
And usually by the time you're in your 60s, mid to late 60s, no matter what your vocation is, you've got seniority, your learning curve is flat, you know what you're doing, your vacation time is 2 months. So where I'm going with it is, you're really not putting in the 60-hour weeks 52 weeks a year, you can ease back a little bit, which may make it a little easier for you.
Also, people don't realize the difference in your Social Security payment between 62 and 70 is 76% higher.
Yeah,
it is 76% higher. Just going between 65 and 70 is 40% higher. Now, if you have a typical life expectancy,
honey, are you listening?
Typical life expectancy, it makes a lot of sense mathematically. I understand the emotional part, but mathematically, it makes a whole lot of sense to stretch out Social Security, start it at 70. Now, when is that not a good idea mathematically? Well, when you're in bad health.
Yeah.
If you got diabetes, you're 500 pounds, nobody in your family's ever lived past 40, and you're already 50. That kind of thing, sometimes it's okay to take early.
And it's a mindset. We both have clients
That's right.
Some retire at 50, and they're planned out, and they're happy. They don't want to work. Others never want to retire.
I'll tell you what, I don't think that way. I think I'm different. My parents didn't work out. Neither did my grandparents. I've worked out my entire life. My mom died at 68. My dad died at 72. I'm still going to take my Social Security at 70 because it mathematically makes the most sense. Even if I happen to retire at 65, I'm going to take my Social Security at 70. That's just what, like I said, it's a mathematical thing to me. And with medical science, people are living longer and longer. Because you think about it, even if both your parents like mine died young, well, in 20-something years, when I'm 80, the life expectancy might be 95 to 105. I don't know. So I need to plan for that regardless. So what's the best way to plan for that? Get the most income. And so delaying Social Security, delaying annuity payments, working for it, because remember, usually your last few years are your peak earning years. You're saving the most. A lot of times you've had your house paid off and things like that, so you're saving the most in qualified plans like 401ks, and you're saving the most outside. That extra 4 or 5 years, even 2 if you can get it, those few years can make a huge difference in your money not running out later on. So that's why they're saying 65 is the new 70.
I think the ideal answer, and this may be too simplistic, but is you retire when you want to, when you feel like it. My running joke is I plan on working to 70 or 70 plus, but I reserve the right to change my mind at 65, right? And if you take care of the income needs, we talk about it over and over, and we really want to get the point across. And you don't have to worry about the income. Your paycheck doesn't stop. Your health is good. Then it's up to you. If you enjoy your job and you love going in every day, do it. If you don't, if you hate it, I've got clients that think job is jail. They hate it. They just want it. They can't wait till they hit 62. Well, then you don't have to worry about that either. Get the hard expenses taken care of. Get your income taken care of.
Well, so who said that? If you love what you do, you'll never work a day in your life?
I think it was Mark Twain, but I could be wrong.
Yeah, Will Rogers, Mark Twain,
Yep,
one of
yep,
them. But it's absolutely true. If you don't enjoy it, I get it. You hate your boss. You hate what you do. You only did it temporarily. I get it. But if you can stomach it, stay with it, guys. Well, that's our show, folks. Remember, if you have any financial questions, just like to talk to us, don't hesitate, 972-715-2424. If you'd like to take advantage of our no-cost, no-obligation written retirement plan, 972-715-2424. You can always go to ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice